Okay, greetings everyone. It's Employment Friday again. And so I'm here to give a little bit of a rundown on what's been going on recently in both the economy and the markets. And we'll end on innovation. First, I'd like to, in terms of laying this out, we'll talk about Elon Musk's pay package. I wrote a tweet. I shouldn't say tweet anymore, should I? On X, I posted last night our point of view, or more thoughts on our point of view, and I'd like to share them with you. Then I'd like to go through, as we normally do, fiscal policy, monetary policy, economic indicators, market indicators, and then talk a little bit about innovation and the indigestion that long duration strategies, including innovation strategies, have had thus far this year after a really good year last year, and what our thoughts about the future are on that score as well. So why don't we start now with some thoughts about Elon's pay package. We know, we can see how controversial this has been, how there are a lot of thoughts back and forth, big debate, and so just want to share our point of view. The first is that I'd argue that no other executive that I'm aware of in history has been more aligned with shareholders than Elon Musk. Elon committed to no salary, no bonus, no stock comp for 10 years unless he created tremendous value for shareholders, for Tesla shareholders. And what that usually means, this is not all about shareholders, that usually means creating goods and services that consumers love and that make their lives a better place. And then doing so surrounded by really good business partners. And that's what we think Elon has done. Now, one thing that people do not understand, and this is important, is that Elon Musk will not be able to cash in on his options, should he be able to exercise them, until 5 years after exercising them. So what that would mean is that Elon probably would stay at Tesla for the next 5 years, which is going to be a crucial period in terms of ramping and gaining traction on the autonomous taxi platform opportunity. So that we think is very important. Now, what were the odds that Elon Musk would hit the goals included in his comp package? And for those who don't know, it was a comp package that included 12 tranches, each with market cap, revenue, and EBITDA, earnings before interest, taxes, depreciation, and amortization. Milestones. But the very first milestone back in 2018, when the stock was suffering so much, was that the stock had to double before Elon could get any pay whatsoever. So we believed, and Tasha Keeney and Sam Corris did all the research to support this. We believed that Elon could hit the goals in his comp package, only with brilliant execution. But most analysts, most auto manufacturers, and most people in the media thought these targets were laughable. They didn't think they were possible at all back then. And in fact, this was 2018 and then 19, when Tesla was scaling the Model 3 through what Elon Musk called production hell. Analysts and media pundits peppered their narratives with the word bankruptcy. In fact, Morgan Stanley at the time put out a bear case for Tesla with a target price of $1. Now, obviously, that forecast was completely wrong. In fact, Tesla, the stock price, shot up to $414 in 2022. So that was a massive scaling as Tesla hit one milestone after another in Elon's pay package. What the company had done was compound revenues at a 49% annualized growth rate, so 49% on average per year. Adjusted EBITDA, 142% on average per year. So profitability increased as Tesla was scaling, and market cap at 91% on average per year from early 2018 to mid 22 when it hit that peak. And even in the last few years, after interest rates have soared 24-fold, and Chinese price competition has become ferocious, Tesla is still somewhere in the $175 to $180 range, which was a far cry from where we started. I believe we were below 20 or roughly around $20 at the start of that journey. So $20 to $414. And even today, after a correction based on macro fundamentals, we're still at that $175, $180 level. Now, what about this $56 billion pay package? That does sound extreme, I guess. Well, it sounds extreme. Now, as Tesla noted at the outset, the accounting fair value of the award in 2018 would have been about $2.3 billion. Why did it get to $56 billion? Well, the size of the award grew in proportion to the value that Tesla created for shareholders. So from 2.3 billion to 56 billion. Now, for perspective, just to put that 2.3 billion into perspective, this is what the board of directors were considering in 2018. For perspective, GM and Ford, each of them, spent $4 billion on advertising in just 1 year, 2018. Elon Musk is Tesla's best salesman. He is the best advertisement for Tesla. Tesla has never paid for advertising until very recently. Certainly not in 2018, 19, 20, 21, 22. That 5-year period, Tesla did not advertise. And Ford and GM each spent $4 billion. So Elon's pay package at $2.3 billion was less than the advertising budget that Tesla would have had to have spent if GM and Ford are any indication, were Elon Musk not the advertising platform himself for Tesla. Now, Elon has not been the sole winner in all of this. Employees, so Tesla's, I believe all of Tesla's employees own stock. They have been big winners, as have all other shareholders. And, board members at the time, if I were in their position, I would be thinking both sides of this thing. Okay, maxed out, this would be a big payday for Elon Musk. But if he had failed, he would have received no comp over 5 to 10 years. and no payout in terms of options. But Elon did not fail. In fact, he succeeded spectacularly, and he should be rewarded accordingly. He did what most, certainly analysts and executives in the auto industry and even in the tech industry thought would be impossible. Now, if shareholders renege on Elon Musk's pay package after 73% of the shareholders in 2018 did vote for it, and that was before all of the risks were diffused, then the public equity market, we believe, is going to lose access to really innovative and creative companies like Tesla, who want to reward their visionaries and their leaders with pay packages commensurate with what they've accomplished. How can shareholders renege on his pay package after Elon and shareholders like us and others who were holding the stock in 2018 have already taken and overcome the risks of production hell and the risks associated with Tesla actually now producing the best-selling car in the world, the Model Y? We do not understand. In fact, we would say reneging on that agreement is unconscionable. And you can go to that post on X and see all the disclaimers associated with what I just said. Okay, let's go on to the usual drill. So starting with fiscal policy, I think the most interesting thing from an innovation point of view that has happened on the fiscal policy front or on the legislative front is that SAB 121 and FIT or FIT 21, both of those are crypto legislation that actually passed through the House. FIT 21 stands for Financial Innovation Technology 21, the 21st Century Act. Now, the first one was vetoed by President Biden, and he considered it. I'm going to look at my notes here. Inappropriate constraint on the SEC, which needs to put guardrails on such innovation in order to protect consumers. FIT 21 passed in the House with 76 Democrats voting for it. The SAB 121 passed in the House with 21 Democrats voting for it. This is very important. Crypto or digital assets has become a single issue vote for many people out there. And clearly, these Democrats have been getting the message because the party had been reticent to vote for anything crypto-oriented. Elizabeth Warren and Bernie Sanders and others having had such a big impact on that side of the aisle. Now, at the same time, we have former President Trump taking crypto donations and making a pledge to uphold the rights to self-custody in the digital asset realm. This is huge and reinforces the notion that this is becoming a campaign election issue. And for young people in particular, it's a very important issue. So this is progress. This is the three branches of government balancing one another out. The executive branch Okay, President Biden vetoed one of these bills. And then the judicial branch has basically said to the SEC, you are out of line in a number of cases here, very notably the Grayscale case, which ushered in the spot Bitcoin ETFs, of course. And so we're focused on it and happy that it's an election issue as these pieces of legislation pass the third branch of government, at least one part of the branch, that's the House. It remains to be seen if the Senate will take up the Fit 21 Act. It is an election year. A number of Democrats are voting now on the side of crypto, understanding how important it is to a significant portion of the electorate out there. So that's the most important thing that's happened on fiscal policy. And normally we're not talking about innovation when it comes to fiscal policy. We're talking about taxes and spending and so forth. And those are campaign election issues. But we'll get more into those as the campaign year progresses here. So let's move on to monetary policy. You can see here, this is a chart that we've presented regularly because we wanted to track how inflation, how correlated it is to money supply growth. So here you can see M2 money supply growth in the purple line. And it had a burst during COVID as the Fed was trying to make sure we did not go into a depression and tried to provide liquidity to the economy. Hit 27% and has been decelerating ever since. It descended into negative territory in 2023. And actually, I'm sorry, this has been pushed ahead. It descended into negative territory in 2022. This chart has been moved ahead because money supply leads inflation. And so you can see the green line, which is the CPI on a year-over-year basis, has paused in here. It's been kind of stuck in the 3 to 3.5% range. And of course, the markets, certainly this year, have been very upset by that because the Fed is saying, hey, unless we see 2% inflation, we're not going to cut interest rates. Now, what we believe has happened here is companies are losing momentum when it comes to unit growth or volume growth. And they've tried to offset that, especially the impact on margins, by raising prices or trying to raise prices. And what we're learning from earnings season is they're not getting away with it. The unit growth has gotten worse for many companies. You raise prices, consumers now on strike are saying, no, we're not doing this, or we're going to trade down to store brands, which are much cheaper. And so what we believe will happen now, and we're hearing this, we're hearing Walmart, Target, Costco, Best Buy, many stores saying, we are cutting prices. Certainly those companies who reported through the quarter ended April, and most retail has their fiscal quarters ended April. We're hearing a lot of price cutting talk. And so we believe that will show up in the statistics going forward. And you'll also notice maybe that gas prices have started to come down again because oil prices have cracked. And you may have heard that OPEC is saying that starting this October, it is now going to expand production again. And so the futures markets are saying that oil prices and therefore gasoline prices will continue to come down. So that will help in the near term as well. As we've been saying for some time, We believe that inflation is going to turn into deflation. In other words, prices will not be rising on a year-over-year basis. They're high and they are still rising. The consumer's on strike. Monetary policy, we believe, is still restrictive, and we think prices are going to crack. And that means they'll go below zero. And you see on this chart, that's where money supply has been pointing. You can see that for the first time in April, money supply on a year-over-year basis turned positive. Now it's only up 0.6%. So that doesn't, if you knew nothing else and said, okay, money supply is correlated with GDP growth, you would have expected GDP growth to go negative, and that would include inflation as well. Well, something else has been at work, and I've referenced it a few times on these calls, but I'd like to talk about it now. And it is the velocity of money. So what prevented the real GDP and nominal GDP growth from going negative when money supply went negative? Well, the velocity of money picked up. The rate at which money turns over picked up. Now, it picked up because we were in a cyclical upturn. The history of money velocity is it has been falling in a trend sense since 1997. That's a long time, more than 25 years. During cyclical upturns, however, it does increase. It usually drops at an accelerated rate during recessions, and then makes up for that and doesn't break the downtrend, but does have an increase cyclically. That's what we have been through. Now we are seeing that the rate of growth of velocity is slowing down. And it's starting to slow down rapidly. It peaked on a year-over-year basis at 10.5, so it truly offset the decline in money supply growth. Now, on a year-over-year basis, it is down to 7%. But if you look at the growth on a quarter-to-quarter basis and then annualize it, we're at half that growth rate. In fact, less than half of that growth rate. So that tells you what's coming here. The rate of velocity growth is slowing down and is no longer a buffer if money supply growth is negative or weak. And it is very weak now. In fact, if we took the rate of money growth at 0.6% on a year-over-year basis, and if that 7% in velocity growth drops to roughly 3.5%, which is where the quarter-to-quarter growth rate is going, then there's very little room for GDP growth. 3.5%, 3.5 to 4%, it accommodates both real growth and pricing. Is it 2 and 2 or 1 and 3? We don't know. But the history of velocity is once in motion to the downside, it keeps going, and we end up in a recession. So we have been saying for quite some time, we're in a rolling recession. Housing has been in recession. Autos are in recession-like conditions. Commercial real estate, office, and now even more multifamily, which is much broader based, in what we believe is a recession. We think consumption is entering a recession. Now, during recessions, consumption does not fall apart unless we're in an 08-09 period. But it has been slowing down fairly dramatically here. And we believe we're moving towards a flattish consumption environment, which is very weak. And we do believe that is why pricing is going to come down. So let me just show you quickly here a velocity chart. This velocity chart is very noisy. But you can see during recessions, which are in the gray shaded area, velocity typically is going down. The zero line you can see there, and velocity is typically falling as we're entering a recession. Each of those times, those gray areas, you can see it may not be down a lot, but it's typically falling. So you can see here, this is velocity on a quarter-to-quarter basis, annualized. So trying to get at, okay, what are we looking at in terms of underlying momentum? It's starting to fall. Why does velocity fall? Typically, velocity falls if people are becoming concerned about their jobs, or concerned that they're going to be facing a wage cut and won't be able to afford much in the future. So the other reason, so in other words, when consumer sentiment is negative, and it's highly negative right now. If you look at the University of Michigan Consumer Sentiment Index, the consumer has not felt this bad since 08, 09. And so, as you may know, that was a very difficult period for the consumer. So we believe the rate of velocity in money, the turnover of money, is going to continue slowing down, and that it probably will go negative unless the Fed eases dramatically. Now, I do understand, those of you who have been listening to me since COVID, actually, which is when we started these In the Know videos, I've been saying that the Fed is going to have to ease. And so the last year we had a great year because we got a whiff that the Fed is going to ease. It stopped raising rates. That's good. But it has not given the market any oxygen this year. Innovation-based strategies have been hit this year, hit pretty hard, even though the market is up. Why is the market up? It's all crowding into a few very cash-rich stocks. And in the next In the Know, I'll show you how unusual this period has been. But right now, we wanted to get through this money and velocity argument. The crowding into a few stocks is, we think, it's being caused by risk aversion. And riskier stocks, like those in the disruptive innovation space, haven't been of interest and won't be in many investors' eyes. We disagree, of course, until the Fed eases. And we do think that is going to be the case. The last thing in terms of monetary policy that I'd like to present is this yield curve. And you've seen this a few times as well. You can see here that the yield curve has been inverted, and it's been inverted for a longer period of time than normal. You have to go back to the late 70s and early 80s to see an inverted yield curve like this. And we had back-to-back recessions when the yield curve was inverted for this extended period of time. And you can also see here that this flattening yield curve has been in place for a long time. The trend towards flattening and then inverting, in a trend sense, it has been in place since the 08-09 period. And that's another indication that the market is highly risk averse. And the confusing part to us has been in the fixed income department, in the fixed income area, that high yield spreads, meaning the amount that high yield interest rates are above Treasury yields, is very, very low. And normally that happens in low risk environments where people are willing to take a lot of risk. Well, we think the distortion there, and we think it's starting to reverse, is private equity, private credit. There's been a huge crowding in to fixed income like instruments, including real estate investment trusts, as this money has been seeking yield. So they'll buy buildings, multifamily homes, and they'll leverage them up, take on a lot of debt, because they'll earn the rent. That's an annuity. Leveraging up means they can leverage that yield. So instead of 5% earning on rental properties, they'll earn 15% or 10%. That has been such a common trade, and there's so much crowding into that trade that I think that's why the high yield spreads have not shown much sign of risk. But we think that's changing. And in fact, someone from Apollo this week, which is a private equity firm, said basically the jig is up. And we would agree with that. Okay, so let's get on to the economy. You know, when I went through all of the economic indicators and said, okay, this one came out better than expected, this one worse, the ratio last month was about 3 to 1, almost 4 to 1, worse to better. So the economy, some headline numbers look fine. And one of them is the employment report that came out today. So the employment report, again, had something for everyone. Non-farm payroll employment, 272,000 person increase. That was much better than the 180,000 expected. The previous month was revised down to 165, so that was somewhat weak, but nonetheless stronger than expected. The household employment is dropped by 408,000 people. Now, what we're learning as we go through and parse through the employment, who's gaining employment? Well, foreign-born immigrants are gaining employment. Some of them legal, some of them not legal. It is native-born people in the United States who are losing their jobs. This is very clear now. Foreign-born employment is out to an all-time high. Native-born employment is down and falling. So that's very interesting to us. And it was very weak the month before at 25,000 as well. The unemployment rate, we've now got a 4 handle, 4%. Remember, it had been in the low 3% range, and then it picked up to the high 3% range. Now we're at 4%. That was worse than expected. Average hourly earnings, better than expected if you're a wage earner, but worse than expected if you're the Fed, 0.4%. Expectation 0.3%. Now, the previous month was 0.2%. And so maybe that averages out to 0.3, but nonetheless, hotter, as the Fed would say. Average work week was just flat. Private hours worked, pretty flat. That's not a strong sign. Temporary help, the last indicator that I think the Fed really pays attention to, down 14,000, and it was down 12,000 the previous. So it has been in a declining trend for a while, as have the leading indicators. I think when history is written and these data are revised, and they are usually revised after a year and then especially after 5 years, I think this rolling recession that we've been talking about will have turned into an outright recession sooner than the statistics have been representing. So, and you know what also explains that is earnings reports. Earnings reports, sure, there are some great earnings reports. Walmart has had great earnings reports. Most other retailers have, and Costco as well, most other retailers, terrible reports. They're very weak. Walmart is gaining share. Costco is gaining share. And it's gaining share at the high income level as well. So as these headline numbers come out and these headline stocks report, I think the sense that all is well. But when you dig into more earnings reports, you will see that is not true, and that margins are coming down. And that we think is going to accrue to the benefit of innovation. Innovation solves problems. Technology is going to help increase productivity and keep those margins as high as possible, even as pricing power diminishes and, in our view, in many sectors will disintegrate. Okay, let's go on to market statistics now. I won't go through a lot of them. May was interesting. After the first part of the year, we saw a backup in a lot of indicators that have not been good for interest rates, innovation-based strategies. Commodity prices had a little bit of a bump. Gold prices went out to all-time highs. And we'll get into that in a minute. But interest rates came down in May. Long rates never got back to the 5% where they were last October. Long rates are telling us something, and those are Treasury yields. They're telling us either or both that the economy is much weaker than people understand, or inflation is going to come down much more than economists understand, or some combination of both. The Bloomberg Commodity Price Index, after a move from below 100, a little below 100, up to 108, has collapsed back to 101, roughly, and is pretty flat on a year-over-year basis. High yield spreads, I mentioned, they actually have started moving up. That means there are some bond investors out there in the high yield world who are saying, okay, there's a little more risk here that I'm taking, and I expect to be paid for it. Now, the yield spread is still very low, but it has changed direction. It hasn't broken a downtrend, but it has changed direction. And I think what the high yield market is beginning to see is there is trouble brewing in it's not just brewing in real estate, in office and multifamily real estate. It is here. And in private equity, it is here. We are hearing of private credit companies, private equity and private credit companies who are being forced to take equity because companies basically would go bankrupt. They've basically run out of cash. And so I think you're going to hear more and more about that. And we're also seeing a lot more bankruptcies, just poof. But these are not getting the headlines. One of these days, a bankruptcy will get a headline. Now, I'd like to just take you to two more charts. This is the gold chart, and you can see it's gone out to all-time highs. I've talked about this inflation here. And this inflation was born in the late 90s and early 2000s. The Fed was easing aggressively. And there were a number of reasons. There was the Russia default in 98. Long-term capital went under in 1998 and put a fear that there would be a systemic risk that would spread throughout certainly the United States, but maybe even the world. Fed ease there. And then Y2K. Y2K, at the turn of the millennium, computers would think we were going back into 1900 because they never put the first two decimals into codes. And so at the turn of the millennium, 20 wouldn't be there. It'd be assuming we're back in 1900. And Fed and technologists thought the global economy would shut down. Fed eased. That did not happen. And then we went into the tech and telecom bust. The Fed eased. So you can see it took a while for the inflation to take off, but take off it did up until 08, 09. We had a bit of a wobble during the recession. And then this part of the move in gold prices, we believe, was out of fear. Insurance policy, never going to go through that problem again. I'm going to keep some of my money outside of the banking system and put it into gold, a safe haven. We think that was more of this move, the second move in 2010, 11, and 12. And of course, we were going through the European sovereign debt crisis as well then. Then you see, we see the gold price go down, it's well behaved, and we test the old highs, enter a trading range between 1700 and it was a little over 2000. And we were there for a few years after COVID. And now the question is, what is this latest gold move all about? Is it more like the gold move coming out of the 2000 period? And we think that was an inflation. That was outright inflation. And we did see some inflation kicking up there. Or is it more like the gold move coming out of 2008-9? That was a flight to safety. We think this is a flight to safety, and we can show you in the next chart why we think that. So here you go. You've seen this chart before. Now, what is this chart telling us? There are a couple of things. First of all, the purple line is the ratio of metals prices to the gold price. And the green line is the long-term interest rate, the 10-year Treasury yield. And you can see how tightly correlated they were in the aftermath of 08, 09. Now, you can also see here that when the purple line was going down, what that meant was the purchasing power of gold in terms of metals was going up. Gold was able to buy more metals per dollar as the purple line went down. And what did that mean? It usually meant we were in a flight to safety. We were in a flight to safety mode. And you can see that certainly was true in 08, 09. In the European sovereign debt crisis, it was true. We ended up at the low end of this range. In 2016, which was in 2015-16, there were fears that China was going to blow up, be overwhelmed with real estate debt. Happened again. There you see COVID. It happened again. And here we are. We are about to break down to new lows. And today is a very tough day for metals. Copper is down 3.5%. Gold's down 3%. The dollar's up. This usually means there's economic weakness, and any rise in the gold price is flight to safety. And as I mentioned, during during 2010, 11, 12, the gold price did go up, and that was a flight to safety. But metal prices were very weak relative to gold because the global economy was very weak. Here we are again. That's what this is saying. And I know that I've focused mostly on the US economy here, but when it comes to the global economy, China is exporting deflation. We know that because it's becoming political in the rest of the world. Janet Yellen has gone to China and said, we're not going to let your low-priced, commoditized electric vehicles into the US. We're going to slap these or keep these very high targets on your cars and stop exporting deflation. It's hurting our economy. Well, China's going to continue exporting deflation because we do think it is at risk here of a very deflationary period itself. In fact, the CPI in China has been deflating. So the economy is still struggling as it migrates from this real estate infrastructure oriented build out, which reached an excess that they are addressing, towards productive forces. That's the new mantra now. And that's all about innovation. So innovation is deflationary itself, but it's good deflation. As these new technologies travel down learning curves, which are expressed in cost declines, then units increase dramatically. That's what they are experiencing with electric vehicles. Their electric vehicle demand is very strong because they're cutting prices so aggressively. That's innovation. And we don't agree that we should be putting tariffs. That's hurting our U.S. consumer. They could have the benefit of this deflation. Now, the other thing to notice in this chart is what interest rates have done, unlike in the past. You now have a gaping jaw between this measure of flight to safety, gold purchasing power going up relative to metals, and interest rates. And if we're right, this gaping jaw will close more by interest rates coming down than metals rising relative to gold. And if we were to take this chart literally, it would suggest that interest rates would, if nothing changed, if the Fed didn't ease, that interest rates, long-term Treasury rates, would go down back towards that 1% level. Why would that happen? A very weak economy, and with the Fed chasing it, driving rates down rapidly in order to resuscitate it. So the truth will probably be somewhere in between. Maybe the metals to gold ratio going up a bit and interest rates coming down. If they meet in the middle, that would be more in the 2.5% to 3% range, which would put it back in the range where it's been for the past several years. So we would not be surprised to see that happen. So now, on a closing note, just on the earnings season and on innovation in particular, it has been such a confusing period for many people. I think those most shocked are the investors holding and analysts recommending a lot of software stocks. They've fallen apart in here. Now, I remember when ChatGPT came out and analysts and portfolio managers, investment teams were trying to figure out, okay, who's going to be the biggest beneficiary of AI, generative AI? And we iterated to the conclusion that those with the proprietary data were going to be the biggest beneficiaries. Well, a company like Salesforce.com, which we have not owned for quite some time, it should be a big beneficiary if data is the biggest differentiator. There's something else that we have been evolving as a possibility here. It is that software as a service is probably going to be a victim, and that infrastructure as a service and platform as a service, so cloud providers and companies like Palantir, and I know UiPath had a difficult quarter. We think that's just a function of confusion out there, but it is in the platform as a service, closer to the platform as a service space. So why would this happen? Well, with large language models are becoming ubiquitous. Some of them are open source, and there are now opportunities for companies to make their engineers even more productive by letting them use these large language models and harnessing them. They'll become more productive, much more productive. In fact, we had a brainstorm today where we concluded that coders and software developers could become even more productive than we were thinking. They've become twice as productive with ChatGPT and other tools. They could become much more productive than that. And so maybe large enterprises can unleash their increasingly productive engineers on very customized software for their companies using their data that other companies like Salesforce.com might have provided in the future. So that's certainly one thing that's come out of this earnings season. The other thing that's come out, of course, and importantly, we've been talking about NVIDIA for a while. No question, has been the most important force in unleashing the AI age and empowering companies like OpenAI and Anthropic and Meta with its open source Llama 3 platform. So very much believe that NVIDIA has led the charge here, and all praise to NVIDIA. But what we've been saying for some time now is that if NVIDIA is going to continue to appreciate at its recent rate, which is quite extreme, of course. I think those of you who know us know that we wrote it for 100-fold move, and we've missed a threefold move. That is what happens as you move into parabolic momentum moves in the market, and everybody jumps on board. But if that is right, the parabolic move here, then we better see some big gains in other companies. And we thought we would see them in the last few quarters. We really haven't. We really have not. Now, what we may be seeing, and we need a few more earnings seasons to determine this, is productivity is increasing. So right now, first order effect is productivity is increasing, better, faster, more productive, more efficient, more creative products and services coming out of generative AI. Maybe that's happening, but it's not clear cut yet. So the picks and shovels, which is how we group, and many people group NVIDIA, picks and shovels has been the first mover, no question about it. But in order to sustain that move, we need to see some real gains, real benefits elsewhere. There's another dynamic at work with NVIDIA. Truth be told, we own it in some of our more specialized strategies. but we are looking behind our shoulders because there is competition brewing. And it's not just AMD and Intel. It's some startups like Cerebras and TensorTorrent. It is in the hyperscalers themselves. Google has its own chip, TPU. Uh, Amazon has its own chip, Graviton. Microsoft and Meta are evolving their own chips. And it does take time. And even Tesla, we just heard that now that Elon has secured the GPUs he wanted from NVIDIA for Tesla and XAI and X itself, he has started production, or Tesla has started production of the newest version of Dojo, which will also be a competitor. So it's a very interesting story. We're fascinated by what NVIDIA has accomplished. We were there very early, pounding the table. Some of you may remember. And now you've seen us pull away or downsize the position because we need the pull through elsewhere. And among the Mag 6, just to go there for a moment, we see real disruption possible. We see real opportunities. Meta platforms, for example, is open sourcing large language models. Really smart. They can afford to do it. Why? Large language models are more enterprise facing. Enterprises are looking at investing in and they have the wherewithal to pay. Consumers won't pay. And so Facebook or Meta platforms, because it is more consumer facing, can afford to put out an open source software, large language model, and have other developers build on top of it, make it better, more performant, and then keep it out there, keep upgrading it, but then take it back into Meta Platforms itself and build specialized consumer-facing models on top. Very powerful, very smart. So Meta Platforms is definitely a beneficiary of this new world. But what about Apple, Google, Amazon? Well, there could be a lot of disintermediation. They can harness AI, but their current business models are dependent on advertising or apps or shopping using aggregated data to attract shoppers. But Google, yes, Alphabet, and it's really interesting because it has some of the finest AI researchers in the world, from DeepMind, which it acquired, a UK-based company. There's innovator's dilemma here because what are they going to do? Okay, a ChatGPT-like product or a personal assistant is by definition going to take me to the website where I can buy website in the developed world, so no fakes, where I can buy Todd shoes at the lowest price, maybe with a discount promo, free delivery in 2 days. It'll take me directly to that site. I don't need to click into any links anywhere else. Same with travel, or other reasons to use ChatGPT. We don't have to go through these specialized sites anymore. And we can skip over Apple's apps. And Amazon, which is a tremendous cloud provider and will benefit certainly from infrastructure as a service and platform as a service, but it's shopping. If we can just go to the site, which gives us exactly what we want. And maybe Amazon is that site, but maybe it's not. It does not have consumer attention like it once had. So, there are puts and takes with each of these stocks. And we think generative AI is truly disruptive. So the idea that the crowding into the Mag 6, the Magnificent Six, which are basically these stocks, to the exclusion of so many other stocks, is, we think, questionable. And by some measures, and I think I mentioned this before, we've never seen this kind of crowding in before, not even during the Depression when people were worried about companies going bankrupt. They crowded into just a few stocks. We went higher this time around. That's a Goldman study, and we'll present it at the next In the Know. So in the meantime, have a wonderful spring, summerish weekend, and we'll look forward to this next month on Employment Friday.